Hello, my name is Redbord.
And I'm Isabella Chase.
Welcome to TRM Talks. TRM Talks is brought to you by TRM Labs, the leading provider of blockchain intelligence and anti-money laundering software.
Last month, the EU Parliament passed MiCA, the Market in Crypto Assets Regulation. MiCA is arguably the world's most comprehensive legal framework for crypto assets and requires crypto asset service providers and crypto asset issuers to take action related to governance, consumer and investor protection, and the environment, and also expands the entities that are subject to the block's anti-money laundering framework.
Today, TRM Talks welcomes Peter Kerstens from the European Commission to talk all things MiCA, to break down the law for us, to get into sort of the nitty gritty of the different components. And we are so honored and excited to have you today. So Peter, thank you so much for joining us.
Awesome. My pleasure.
No, this is great. We were just joking right before we jumped on camera that we've never done a co-hosted TRM Talks before, but Isabella and I felt like, we needed two of us to ask all these great questions of you. So without further ado, look, we're going to dig into MiCA and really sort of get down to the nuts and bolts. But before we do, you have been referred to, and I know you don't love this, as the father of MiCA. And I would love, it's just so extraordinary in this moment. Would love to kind of hear about your journey to the space, to cryptocurrency, to digital assets, and really sort of how you came to play the role that you did in MiCA.
Well, Ari, as they say, success has many fathers and failure is an orphan. And if MiCA is a success, even before it actually entered into force, I'm quite happy to be associated with it and have been associated with it even from way before its inception. My journey in digital assets really started in 2017, or even maybe a little bit before that. So I'm actually a career official at the European Commission. I've been with the European Commission for 27 years now. Most of that time was in financial services, but I've also done other areas. And between 2008 and 2013, I was based in Washington as the EU's finance counselor. And coming back from that stint, I was very struck by how digitalization was disrupting, but also providing enormous opportunities for finance, for financial services, and mostly for financial services customers, because that's who we look at first. And so I was making a lot of noise at my organization, the European Commission, about all the wonderful things that were happening in innovation, also some of the risks. And after a while, my bosses got fed up with me being so enthusiastic about it. So they made me advisor and said, look, if you're so keen on this, you're in charge. You're now our advisor on technological innovation and cybersecurity. Get on with it. And so I started looking in a number of what I call foundational technologies in the digitalization space. Started with mobile phones and smartphones, cloud computing, high capacity computing. But then very quickly I got into blockchains and distributed ledgers. And I think the first time I heard about Bitcoin and the emerging altcoins was somewhere in 2016. Before that, I'd never heard of it. I didn't know what it was. But it immediately triggered my interest because I saw how digital assets could potentially overcome some long-standing problems which and tensions and frictions which we have in the financial system. So I saw enormous opportunity in this. I also saw some risks, of course, and my interest got sharpened in the course of 2017 when we saw the first very big Bitcoin rally, the emergence of altcoins, but also what I would call the initial coin offerings craziness, the ability to raise vast amounts of money on half-baked and not baked at all ideas was actually quite interesting because from a financial services perspective, we were always interested in, well, what ways are there to create capital markets to raise money? And so crypto offered an opportunity there. So that really is where my journey started. I saw the opportunities, also the risks. And so I've been looking at distributed ledgers, at blockchain since 2016, 2017, which makes me, I guess, an old guy in this area by now.
Yeah, I love that origin story, because yes, the old guy narrative, but you know, really started out in sort of the most Wild West version of this space, and have sort of seen through sort of the most comprehensive regulatory framework, right? I mean, just really interesting perspective. To that end, would you sort of give our viewers an overview of MiCA? There's a lot of different aspects of the legislation, but really sort of maybe a high level overview of really what it encompasses.
There were really two big elements that led to MiCA. First was the big boom and then bust cycle 2017, 2018, and the ICO wave. So the fact that all of these tokens were created. So that led to the first ideas of saying, well, look, this is really quite powerful, but it needs a regulatory framework, because all of this activity was taking place outside of regulation, and our existing regulatory framework couldn't really be applied to it. So that's when the thinking start of it. But what really set it in action, what created the political momentum to propose MiCA, was the emergence of stablecoins, and in particular, the Libra initiative. So I would say 2017-18 was a first push, and then the announcement of Libra, which was in spring of 2019, that really set things in motion. And it's these two drivers that also determine what is actually in MiCA. So basically, there are three big elements in MiCA. First is it's a framework for the issuance or placing on the market of crypto assets. And if you issue crypto assets, you sell them to investors, you have to meet disclosure requirements. And these disclosure requirements have to be put in a white paper. We use the term white paper because that's the term which is also used in the industry. And these white papers will have to be produced according to a certain standard. So they must have certain elements about who you are, what it is you're offering, what, if any, rights are attached to the tokens, and so on. And there are also important prohibitions. And the most important prohibition, inspired on the very bad marketing which we saw at the time, was that if you issue a general crypto asset, so a crypto asset which is not backed by anything, you are not allowed to make any representation whatsoever as to the future value of this token. And you must warn investors that it may have no value at all, and that they may find it impossible to sell it, or that they may find no liquid market for it, or that the utility they promise to develop may never materialize. So a lot of warnings to discourage, I would say, to even discourage people from buying it. And that was inspired by the very bad marketing practices which we saw in 2017, 2018, when people were promised Lamborghinis. If you buy this coin, this Lamborghini is going to be parked in front of your door in a couple of weeks' time. So we didn't want any of this stuff. So that was the disclosure regime, so clarity, but also important facts of warnings. And then, as far as the issuance regime is concerned, there's also a specific issuance regime for stable coins. Now, MiCA doesn't use the term stable coins, but these are coins which purport to have a stable value by reference to either a currency, a single currency, then they're called electronic money tokens, or if they purport to have a stable value relating to a basket of currencies or commodities or a combination of it, then they're called asset reference tokens. And for these, MiCA has an authorization regime, a licensing regime. So you must be authorized before you're allowed to issue them. You must produce a white paper with the necessary disclosures, but you also must hold the assets against which you peg your token in reserve. And MiCA provides requirements on how this reserve has to be managed, what it can be invested in, what not, because this reserve has to be available always for your redemption obligation. If you issue what we call electronic money tokens or asset reference tokens, you are obliged to redeem those tokens against their preferred assets on request of the holder. That's the first part of MiCA, the issuance of crypto assets. So disclosures and authorization for issuers of stablecoins. The second big part of MiCA really is to do with crypto asset service providers. What we saw already in 2017 and 2018 was an emergence of an entire new industry of intermediaries, crypto asset service providers, brokers, exchanges, trading venues, advisors, portfolio management, whatever you, so all kinds of services. And you see very similar services in traditional finance. And although distributed ledgers and blockchains allow for peer-to-peer transactions and people not needing an intermediary, what we see in practice is that most people engage with crypto assets through an intermediary because it's more convenient, because they, or for whatever reason, they want to use an intermediary. And these intermediaries needed to be brought into the regulatory sunlight. So MiCA has a licensing regime. You need to be authorized to provide these services, and you need to be subject to prudential requirements, so a bit of capital, management and governance of these entities, but also, for example, conflicts of interest that these entities may have. They have to manage these. Certain activities cannot be combined. For example, if you are the operator of a trading venue, you are not allowed to trade on your own venue with your own capital. So proprietary trading on your own venue is not allowed under MiCA. Other requirements, for example, are the clear requirements on the segregation of customer assets. So you cannot pool the customer assets with your own assets or use customer assets for your own purposes. These are a number of requirements of a prudential and market conduct nature, which are set out in MiCA. And then the third element of MiCA, which applies to both issuers and to crypto asset service providers, is a single licensing regime, a passporting regime, meaning that if you are authorized in one member state, you are good to go in any member state, either as an issuer or as a service provider. That really is MiCA.
Thank you so much. And I love how you sort of broke that into three buckets. One thing I think people don't miss is I love that you sort of mentioned Libra in terms of the context of this. You know, I was at the U.S. Treasury Department when Libra launched, and we got on a plane and I went with the undersecretary to Switzerland, and we met with FINMA and regulators. And I think what people don't remember from that time is it really was the beginning of setting off this sort of global regulatory conversation that we've essentially been having ever since in this space, right? This idea of a basket of fiat stablecoin backed by a basket of fiat currencies, that with the reach of Facebook essentially really caused regulators to start moving, and MiCA is really kind of what we see years later as it very much the result of that. So really, it's so cool to have the context, and thank you for breaking it down for us that way.
Yeah. Mm. And if I may on this, what we wanted to do is we wanted to enable and to onshore crypto activity in the European Union. So we said, look, investors, consumers want to buy this, and rather than them going to small islands with lots of palm trees to risk their money, said, look, why don't they do it in the sunshine? So it was MiCA is both an enabling regime to onshore this activity, but what the Libra announcement brought was a sense of urgency that we needed to also have control, in particular, of these stable coins. So it was both enabling but also controlling put together.
Mm. Yeah, it's also so, as Ari was saying, it's great to hear about those drivers that brought MiCA to where it is at now. And another thing that was happening sort of back in 2017, a bit earlier as well, was lots of concerns about the exploitation of emerging technologies in the EU for things like money laundering and terrorist financing. MiCA covers lots of different aspects of financial regulation, but less so money laundering. That's covered in the AML package. Can you tell us a little bit more about how MiCA will interact with the AML package and also the transfer of funds regulation, aka the travel rule?
Yes, indeed, because a lot of people, when they talk about regulating crypto assets, immediately what comes to mind is money laundering, as if crypto assets are only used or mainly used for illicit purposes and money laundering, which I must say is not true. The biggest use of crypto assets is not for illicit purposes. It's mainly used for payments and for speculative purposes. But there's also indeed illicit activity. There is money laundering going on. And we did not include money laundering rules in MiCA because the money laundering rules at European level apply horizontally, meaning they apply, we have a anti-money laundering regime covering all financial sectors. Just like our banking legislation does not contain specific rules on money laundering, or our securities regulation does not contain specific rules on money laundering, or our funds management rules do not contain anti-money laundering rules. The way our money laundering rules work is we have a horizontal cross-cutting piece of legislation on anti-money laundering, and it says that if you are a financial entity, you are an obliged entity. You must comply with the anti-money laundering obligations of know your customer and customer due diligence. So what MiCA does is MiCA makes a reference to the AML package, and the AML package, which is currently being updated and negotiated, says that if you are a crypto asset service provider under MiCA, you are also an obliged entity under the AMLR directive and regulation. So currently the AML directive, AMLD 5, applies only to fiat to crypto on-ramps and off-ramps, but we're now extending this to all the crypto asset service providers. So that is the reason why MiCA does not contain substantive anti-money laundering requirements, because they are in the general anti-money laundering legislation, but that legislation refers back to MiCA to identify who is covered by the legislation. We have a specific piece of what's called the transfer of funds regulation, which is the implementation of the infamous or famous travel rule from the Financial Action Task Force, recommendation 15, I think that is. And we had that originally called the transfer of funds regulation. And what that regulation was about was information that must accompany the transfer of funds being fiat money, commercial bank money. And what we've done is, because crypto assets aren't funds or do not meet the definition of funds, we have extended the transfer of funds regulation, which applied only to funds. We have extended that to now also apply to transfer of crypto assets. So the transfer of funds regulation really is a regulation on information that must accompany the transfer of funds or the transfer of crypto assets, information on the recipient of the transaction, but also information on the sender of the transaction. So these are the two legs of anti-money laundering rules which sit alongside MiCA, but which refer to MiCA to determine their actual scope.
And that's a really good summary. And of course, important to note that the TFR was voted through Parliament on the same day as MiCA, but anti-money laundering regulations is a little bit behind, not behind, but more behind in the process. It enters its trilogues tomorrow, and there are lots of areas that still need to be negotiated. For example, the status of NFT platforms and also the interpretation of DAOs and DeFi, which leads us really nicely onto our next topic relating to all things crypto asset and illicit finance. The big topic at the moment really is DeFi. Recently, we've seen the US Treasury release its illicit finance risk assessment of DeFi. The UK and France are also assessing the risks of DeFi within their own consultations. How does MiCA consider DeFi as a topic? And can you give us a feel for where the EU intends to go on that topic and mitigating its risks?
Okay. Well, first, MiCA, like any piece of financial legislation or any piece of legislation, really focuses on intermediaries, either the issuers or the crypto asset service providers. Now, if there is no intermediary, if there is no service provider, it is very hard, if not impossible, to regulate this through legislation that is administered through intermediaries. And just like banking regulation regulates banks, and securities regulation regulates issuers and service providers in the security space, MiCA regulates issuers and service providers in the crypto space. If there is no intermediary, you can't really regulate the non-intermediary through a piece of legislation like MiCA. But it's not because you use decentralizing technology or you also use blockchain that you're not covered by MiCA. And I would like to give a shout out to Jason Gottlieb from Mars & Cohen, who coined the phrase, at least he coined it for me, of DINO, which is decentralized in name only. We see a lot of people that present themselves as DeFis or as DAOs or whatever, but they aren't really decentralized. They pretend to be decentralized because it's very en vogue, or they say, oh, we're decentralized and therefore we don't have to comply with any of these rules, or you can't apply these rules to us. But that's not true. If you are an identifiable person or entity or an intermediary, you must comply with MiCA if you provide services covered by MiCA or if you're issuing. But that said, there is also a pocket of activity developing. It's very interesting, very fascinating, which is what I would call genuine DeFi, where there really is no identifiable intermediary. And that is putting regulators in the EU, but not only in the EU, it's putting regulators across the world in front of a major question, because they will have to come up with a new paradigm of how to regulate non-entities. This is really what I call the cutting edge of regulatory innovation. Like, how can you do this? And I hear many ideas on this, most of them unworkable or pretty bad. But I'm hopeful, every day I'm hopeful that I'm going to wake up and a good idea on how to do it is going to come to us. So far, my hope has been in vain. I've been disappointed every day, but I know it's a matter of time. Any day soon, or not so soon, it'll come, and we'll get a hook on how to approach this, if we need to approach this, because this genuine DeFi activity is relatively small. And so the question then emerges, well, if it's really small and if it doesn't really present a problem, does it need a solution? Because sometimes the solution can be worse than the problem. And we do not get involved if the solutions which we can come up with are worse than the problem we're trying to address. But genuine DeFi may grow, and it may present problems of consumer protection, investor protection, financial stability, market integrity. All kinds of issues could emerge in this DeFi, this genuine DeFi space. And if they do, we hope that at that stage, we will be ready to come up with a good idea. At least the European legislator cut us some time, because it required us to come forward with a report and ideas on how to do this within 18 months after the entry into force of MiCA. Now, 18 months is a long time in crypto space, but I'm a civil servant, and my former boss told me that time means nothing in the life of a civil servant. So 18 months is like tomorrow.
I love that approach. I will say, having spent about 15 years in the U.S. federal government, I'm not sure I agree. Time was very real. But I love that. And I love that you invoke Jason's Dino thing, because I think that it really is sort of where regulators seem to be sort of coalescing today. And that is around sort of levels of centralization, even the U.S. Treasury, which says essentially, hey, we want an activities-based regime where if you're engaging in financial services, you have certain requirements. They're still saying that I think they're still saying essentially that there is that genuine DeFi, as you say, sort of that very small group that probably is outside of the regulatory frameworks that exist today. And I think it's where you're going sort of is the very beginning of a conversation around this. I guess to sort of finish the thought on here, or ask you to finish the thought, where do you think the EU is today? I know no one likes the term MiCA 2, but is there a world where there is continued conversation around sort of what a DeFi framework would look like?
We are very much investigating. We are fascinated by the developments, and I'm struck every day by what is possible. Like the first time I came across DeFi, people talked about DeFi lending and DeFi insurance, and this was like a mind warp for me, because I said, look, you can't borrow from a protocol. You can borrow from someone, or you can't be insured by a piece of code. You can be insured by an insurance company. So I had to go through a mind leap to see that this was possible. And then you say, well, is this possible? Is it interesting? Does it present problems? What are these problems? Are these problems of a financial stability nature, of a market integrity nature, of a consumer protection nature, or not? And if these problems are really significant, and we have to see how the market develops, then we will see how we can address them at the European level if we have to. But before that, we want to really discuss that also with our partners, for example, in the Financial Stability Board, where we're looking at it. We at the European Commission, and our department, the Financial Services Department in particular, wants to look at DeFi not only from a risk point of view, because we also see opportunities. Like every time you centralize an activity in an entity, the entity itself becomes a risk factor, because the entity may become insolvent and so on. So does the fact that the service provided without an intermediary, does that take away the risk that the intermediary becomes insolvent? This is an interesting question, which we don't know the answer to yet. So, but we say, look, let's look at the opportunities and the risks and see what, if any, good ideas emerge on how to address this. Because if we don't come up with good ideas, and if the thing just explodes, we may end up having to act on not so good ideas, and I would really like to prevent this. So we're really at the thinking stage, and anyone out there listening who has great ideas on how to tackle genuine DeFi, do reach out to us. I'm all ears for good ideas and bad ideas. I'll try to sort of filter the good ones from the bad ones.
Fantastic. I think that the tone that you're taking is very much a tone that we're seeing regulators take, and that is we're hopeful that there are technological solutions. Obviously, at TRM, we believe that there are technological solutions, whether it's blockchain intelligence and digital ID and sort of these types of technology, private sector solutions. And I love that you're looking to industry for that type of innovation.
Absolutely. And I think it's also about not just utilizing the technology, but also, as Peter was saying, about having a bit of a mind leap in terms of how we conceive of meeting and reaching regulatory objectives, because it's not going to look like how it did in the intermediated world. So there's definitely a way to get to the outcome, but I think the inputs are going to look quite drastically different. And I think we all, the industry, but also regulators and supervisors around the world, need to go on that leap to get to where we need to be.
Yeah, this is an entire TRM Talks that we'll bring you back for, Peter. I think it's sort of like TRM Talks, sort of like what's next and like where are we going from here? And we do have some questions at the end around that, but like I'll take you back to MiCA for a minute, and I think particularly in that sort of first basket, and I use the term basket sort of ironically here, I guess, around stablecoins. And MiCA, as you mentioned, sort of was birthed in many respects out of Libra and the launch of Libra and sort of that stablecoin, that specific moment. But obviously, so much has happened since then and continues to happen. We had obviously Terra Luna, which was a major sort of issue, the crash of that stablecoin on the industry, the depeg of USDC, a few months ago, the rise of Tether and the use of that stablecoin. Talk a little bit about how sort of like great legislation, right, is pretty flexible to deal with sort of the moment. Talk a little bit about how sort of MiCA addresses those sort of more recent issues?
Okay. Well, first of all, MiCA does not use the word stablecoin for two reasons. One, they're not stable and they're not coins. But that apart, there is such a thing as what we call coins, which purport to have a stable value by reference to another asset. So like you got Tether, which is pegged to the US dollar, or USDC, which is pegged to the US dollar, and so on. So you got them. So we have two categories. One is those that are pegged to a single official currency of any country in the world, dollar, euro, pound, whatever, doesn't really matter. Those are what we call electronic money, and in tokenized form, electronic money tokens. And so you must be, to issue them, you must be authorized to issue them in the EU. You must be authorized. You are subject to capital requirements for your to assure your capital adequacy and your solvency, and you are subject to reserve requirements. So the assets underpinning the tokens which you've issued, you must hold in reserve. So if you issue $1 billion of electronic money tokens or stablecoins, you must hold $1 million in reserve, because this money has to be available in case the holders of those tokens want to redeem their tokens. If there's a run on you, if they say, look, I don't want these tokens anymore, I want the cash for it, you must be able to surrender them. And the same we have for asset reference tokens. So if you create a token, and Libra would have been an asset reference token because its original concept was it was going to be a basket of currencies. Now then it was going to be a single currency, and then it completely disappeared. But we see people who want to tokenize commodities. Now we'll have to look at that stage whether that actually is a commodity derivative, in which case it's not covered by MiCA. It's a commodity. It's covered by our existing financial regulation. But if you say create a token which is backed by some currencies and some commodities or any combination of it, it's an asset reference token, and you are subject to also reserve requirements, because you must be able to deliver the counter value, the asset reference value, to the customers who wish that. Now, luckily, you don't have to, if you have, say tokens backed by pork bellies, you do not have to surrender pork bellies. You can actually surrender the fair market value of those pork bellies or the gold or whatever the assets are, but you must disclose up front how you're going to calculate that fair market value. If you grow very big as an issuer, and that's important in MiCA, you're no longer going to be supervised at the national level, but you're going to be supervised at the European level. The European Banking Authority will become your supervisor. And this will happen to what we call significant electronic money tokens and significant asset reference tokens. So stable coins, very importantly, you must prior approval, you must hold a reserve, and you must redeem at par. And that's to round off. You mentioned Terra Luna. Is that Terra Luna would not meet the definition of a stablecoin or an asset reference token under the EU, because it was pegged to the dollar, but it didn't have dollars in reserve, and that is not allowed. If you are pegged yourself to a dollar, you must hold dollars in reserve. If you don't do that, you fall into the category of general crypto assets, and if you're in the category of general crypto assets, you are not allowed to make any representation as to the future value of your token, including a stable value. And therefore, a algorithmic stablecoin which does not have reserves is actually not permitted under MiCA.
Terrific. Yeah, no, thank you so much for that answer. And I think that's really helpful context to sort of separate out these fiat-backed stable coins that have one-to-one reserves with sort of something that is very different, the sort of algorithmic model. Before we sort of move on, and we have a bunch more questions for you ourselves, there are a couple of good ones in the chat, both business related And I will say that actually, I'm glad people are asking these types of questions because I think they're really important as well. And I'm not sure I was going to get there. So this is great. I'm going to sort of combine them. First is sort of what are the impacts that you're seeing today already from sort of a business perspective? What is the sort of, is Europe either seeing now or going to see this sort of influx in interest of businesses because of MiCA's sort of legal clarity? And then there's sort of the second question that I think really goes to it, and that is there's this sense that like banks that already have licenses to do financial services, in Europe may have an advantage over crypto firms that are now sort of going through that process, which you mentioned is onerous, right? For good reason, the white paper process and all of that. Do banks have an advantage, and do you see them leaning in to sort of the crypto asset space because of sort of the legal clarity that MiCA engenders?
Okay, well, that's two questions. One, what is the effects which we see already or which we expect? Now, we wanted two things. One is we wanted to onshore crypto activity in the EU, and we wanted to make sure that the crypto activity for consumers could take place in the sunlight, so they would not have to go outside of the EU to buy or to trade and so on. They could do it within the EU. Now, that doesn't mean that we are encouraging people to engage in crypto markets. They should decide that for themselves. We're not giving investment advice. We're not saying buy Bitcoin, buy this, buy that. But we took the view to say, well, look, if you're going to do it, do so with regulated firms, regulated in the EU. So that is now, because MiCA is not yet in place, we don't see that effect yet. But an effect which we do see, or which we appear to see, is the fact that we see more investment, venture capital investment in the crypto space in Europe, or at least relatively speaking. As we see lately, as a result of the crypto winter, investment was going down a bit, but Europe has kept a much bigger share of the investment. And now the causality is hard to determine, but many people have observed that this is due to the fact that there is a clear and legal framework on the horizon. So the trajectory of travel is very clear, and that is motivating investors to opt for the EU as opposed to some other jurisdictions where things are as clear as mud, I think, as to what rules apply. So the legal certainty element is driving investment, and that is something which we intended. So that's a good effect. On the other question, do banks have it easier? Do they have an advantage? Well, I would say yes and no. There are advantages to being a regulated bank in terms of access to central banks and so on, but there are also disadvantages. The regulatory requirements applied to you are quite strict, and they are stricter than in MiCA. So because they are subject to heightened requirements, they're also allowed to engage in crypto activity. So from that point of view, they may already have met some of the hurdles and they may have it easier. But on the other hand, banks, for example, will also be subject to the recently emerged Basel standards on capital requirements for crypto exposures. And these are quite conservative. They weren't invented by the EU. I must say, personally, I find them quite strict and probably a bit sort of over the top. But that's my personal view on it. And I'm not a banking regulator. I don't know much about capital requirements. So I'm really talking about something I don't know much about. But if banks get engaged in this and they take crypto assets onto their balance sheet, they're going to be confronted with rather strict capital requirements coming out of Basel. And therefore, I don't think that as a whole, banks will have it a lot more easy than other non-bank crypto asset issuers or crypto asset service providers.
Perfect. Yeah, no, thank you very much for that. And it's really important. I mean, you hear not just sort of EU policymakers already coming out and talking about MiCA as a business advantage, but you even see, quite frankly, US and other policymakers coming out and saying, this is an advantage for Europe. And now we need to sort of meet the moment ourselves, sort of in our own jurisdictions. Really, really interesting from a business perspective. Businesses need clarity, and MiCA definitely provides that.
Absolutely. And I think we all saw that chart on LinkedIn this week showing the movement over the last 4 quarters of VC funding in crypto, which really exemplifies the point that you were making there, Peter. And also when we look even within the EU at places like France that have sort of really built a bridging regulatory framework between now and MiCA, the amount of licenses or big crypto names that they're attracting for licenses and authorizations has been pretty significant. Staying on sort of recent news and hot topics, another big topic is the digital euro. And around the world, we see about 117 different countries experimenting to some extent with a central bank digital currency. Back when MiCA was drafted, a digital euro was looking quite unlikely. Now, a little bit more like it could happen. How do you see this patchwork of digital payment mechanisms all sort of weaving together across the EU?
That's a good question, because I don't know what the future will look like and how they will all interrelate. Interestingly, is that the development of crypto assets, and in particular stablecoins, were a big driver for the central bank digital currency debate. So it was a fact that private money, private stablecoins had the potential of becoming very big, especially if they were backed by big techs with huge network effects, that could sort of present competition to central bank money. And this, in my view, led more central banks to take an interest in central bank digital currency, whereas before that they said, look, we don't really need this, we don't have a problem to solve. So that's where it is. That said, it's not because that was the trigger for the interest in central bank digital currency that the central bank digital currency solutions will be crypto solutions or will be distributed ledger based or blockchain based. They may be different. And you see another driver in the debate for central bank digital currency, which is the gradual disappearance of central bank money for retail use. Wholesale users, banks, they already have access to central bank money in digital form. But retail users, you and me, consumers, the only central bank money we have access to is cash, notes, and coins. And although they remain very popular, we see in a number of jurisdictions they're going down. Their interest is going down. So the question is, well, we need to have a public alternative of payment means, and that's a driver for a central bank digital currency, to have a public option. The second driver is that cash cannot be used in the online environment or in a Web3 environment. So you need to have, so if we're going towards a online economy and a Web3 economy, we're not there yet, but we are taking steps towards. I don't know whether we'll ever get there. Personally, I think we will, but I don't know. I can't predict the future. But if we are moving to a online first or online dominated economy, there is no public money available in that economy, and therefore, if you want the central banks and public money to play a role, you need to have central bank digital currencies that can operate in that environment. That could be blockchain based, but that don't have to be. Could also be different. But so currently, what the ECB is mainly thinking about, the European Central Bank, and no decisions have been taken on this yet. So it hasn't been decided yet as to whether they will issue it or not. But they're investigating the creation of a retail digital euro, which would be a payment system based on a public euro, a claim on the central bank, and that would then coexist along the existing payment systems, which are all based on commercial bank money, and we'll need to see how that develops. Also, interestingly, but that's more for the wholesale, is the ECB is also announced that it's going to look into an experiment with the use of distributed ledger technology and tokenization for wholesale markets. And that, of course, is important for wholesale banking markets, but also for example, securities trading and how these transactions have to be settled. Because currently, if you're trading in crypto assets or you're trading in securities, you can settle them only in stablecoins, which are private money, or you can settle them in commercial bank money. You can't settle them in central bank money, not at least as a user. Only banks have access to central bank money in digital form for the time being.
It's a fascinating conversation, and it's happening globally. I mean, ironically, I should have you guys both on at the same time. We had Chris Giancarlo, former CFTC chair and sort of head of the Digital Dollar Project, on TRM Talks last month to talk about sort of the future of a digital dollar potentially, and a lot of the same issues, quite frankly, right? When you're talking about democratic principles, right? Sort of what should be the privacy standard? Is it cash? Is it something else? What role do intermediaries play? And it's really interesting to think about how the EU is looking at it, the UK, how the US, and really sort of across the globe. I think it's one of just a number of really key issues right now. One sort of just going back a little bit, sort of, there's a great question here in the chat on sort of the AML package and where things are today. The question specifically is sort of, if in fact the sort of AML package is being developed to close gaps, regulatory gaps potentially, what are the key pressure points that we're going to hear in the trilogues over the course of the next, the coming days and weeks? What is that? How do you see that conversation shaking out? Are new things discussed around NFTs and DeFi? But sort of it's a little bit of a future-looking question in terms of what should we expect from these trilogues?
Well, the big issue in the AMLR discussions is the creation of an anti-money laundering authority, European authority. That's nothing to do with crypto, but that is the big issue. For the crypto enthusiasts, and I think there are many people on this conversation that are crypto enthusiasts, they are really focused on how the AMLR will deal with non-fungible token platforms and how it will deal with DeFi. And this is due to the fact that non-fungible tokens, how they're covered by MiCA, is a source of great confusion. So MiCA does say specifically that it does not cover NFTs. But in its recitals, it takes a very narrow view as to what is an NFT. So if the token is part of a collection or a series, then it is actually no longer considered an NFT, but it's considered a crypto asset, so then it is covered. But real NFTs, the ones which are not covered by MiCA, and therefore service providers to NFTs are not obliged entities under AMLR. But there's a problem, because just like crypto assets can be used for money laundering purposes, so can NFTs, in particular if NFTs carry high value, to engage in large-scale money laundering, you need to have assets that can carry a lot of value. And if NFTs can carry a lot of value, and some of them do carry a lot of value, they could be used for money laundering purposes. And therefore, I understand very well why, as a result of the fact that the legislator wasn't the European Commission that proposed to exclude NFTs from MiCA, it was the Council, in particular the member states, who proposed the exclusion. And as a result, the Parliament has said, well, we still have a potential money laundering problem on NFTs, and therefore they want to create a fix by including NFTs directly into the anti-money laundering regulation. So that's going to be a discussion as to how this is going to play out. The second is decentralized finance. So, well, as I said, MiCA only applies to intermediaries, but what if the activity is generally decentralized? Does it allow for money laundering or illicit activity? It probably does, and I think there will be a degree of illicit activity in the decentralized space, and so you can then try to incorporate that into the anti-money laundering regulation. But there's going to be a problem, and that is that the entire architecture of the anti-money laundering regulation is around obliged entities. So if you want to include decentralized finance into AMLR, you will have to say who are the obliged entities. And because we've already said there are no intermediaries. So
every one of these conversations goes back to that question, and it is so interesting. All of our frameworks, right, are reliant, particularly anti-money laundering frameworks, are reliant on intermediaries. That's who's regulated, and this whole idea of truly decentralized finance turns it on its head. It's it's going to be really a real challenge for regulators, going forward.
So I expect that the compromise, but we'll need to see where it goes, will go into a little bit as when decentralized isn't really decentralized, when the decentralization actually still allows for the identification of an intermediary, and it will then specify that, yes, you are also covered by, as an intermediary, even if you're not incorporated, you can still be subject to anti-money laundering requirements as an obliged entity. But if it's genuinely, if there is no obliged entity in the mix, I can't see how you can apply the AML framework to such non-entities, because you don't have an obliged entity.
Yeah, that's a great answer, and I really like the point you make at the beginning, that the main issue in the trilogues is making a decision on the anti-money laundering authority and where it'll be based, because I was looking at the agenda for the first trilogue meeting, and it is just jam-packed with the greatest hits of all of the AML challenges that face regulators around the world outside of crypto. And crypto is one of many issues that needs to be resolved. We've got PEP classification in there, UBO registers, investment visa schemes. It's a really chunky agenda for the trilogue. Going a bit more global, before we've only got a short amount of time left. When MiCA was first drafted, it really was sort of the first attempt around the world to create a comprehensive framework for digital assets. And since then, we've seen the development of various different types of frameworks around the world. Do you see in any of the sort of newer frameworks, so anything that you find particularly interesting or a positive approach? And to add to that, having been through now, feels like you're coming to the end of the MiCA process, are there any lessons learned that you would love to share with other countries who are beginning to set up their regulatory frameworks for digital assets?
Well, some of the now emerging regimes, of course, benefit from the advantage of hindsight, and they're also later in the stage. So certain developments came too late for us in a way. For example, MiCA does not cover staking and staking services, because at the time MiCA was drafted and negotiated, the activity of staking just wasn't a real thing. So we couldn't incorporate it. And we see that the newer regimes are looking also into that. So that, I think, is fascinating, because I think that especially the entire business of staking and staking services is something that merits regulatory attention. For the rest, what I'm most heartened by is the fact that we see what's called in political science the Brussels effect in motion. The fact that other jurisdictions are emulating EU regulation. And that's good, because in regulation, there's such a thing that there's no copyright on MiCA. So people can plagiarize as much as they want.
This is why we're doing Where in the World is Peter these days, because everyone wants to hear from you on how to do this.
So, well, they can just take it, and once it's published, it will be published in 23 languages. So if you're in a jurisdiction where English is not really dominant, you will have it in Spanish, in Greek, in French, in Italian, in any of the 23 official languages. So that may contribute further to this Brussels effect. I'm joking with people, of course. Doing a carbon copy of MiCA is not going to work, because it's written for the EU legislation, sort of among member states, with licensing and passporting. But a number of substantive requirements of MiCA, I think and I expect to be replicated in other jurisdictions, because my colleagues, my peers from other jurisdictions, take a very keen interest in it, and why we wrote it like that, and what we're trying to achieve, and what was the compromise. And MiCA was negotiated between 27 member states, and the European Parliament, and all kinds of possibilities and options and permutations were discussed. And this is where we landed. So if this is the result of a very deliberative political process where all different views, from people who are very pro-crypto to people who are very anti-crypto, sort of landed together, this provides a very decent basis, I think, for also other jurisdictions to find similar compromises. Because if they have the same conversation in Asia or in Africa or in South America or in the US than we had in Europe, I would be surprised that they would end up with a very, very different result. If the debate is the same, and from what I can see, the debate is very similar in other jurisdictions as it is in Europe, then also the outcome is not going to be dramatically different. So I don't think that people are necessarily going to copy MiCA, but they're going to end up in the same space because they're having the same conversation with the same drivers and the same perspectives battling each other out.
So less of a carbon copy, but more of a Creative Commons use of the legislation.
Yeah.
So in terms of, I mean, it like you say, it's so detailed, and when you have the benefit of 27 member states discussing, you're probably going to end up as in somewhere that is broadly useful. In terms of what's next, we have had the discussion. We now enter a big period of rulemaking and implementation. When we think about what crypto businesses should be doing now, what should they be doing now to get ready for MiCA and to some extent also the TFR?
Well, two things. One is they should build. I think the interest of crypto is not mindlessly moving around and trading crypto for speculative purposes. If that's what you fancy, but there's no real societal value in that. But build useful applications on blockchains, on crypto. That's what firms should focus on. And secondly, don't wait with complying with MiCA. It'll enter into force soon, and then it will become applicable, the stablecoin provisions, 12 months after the entry into force, the other provisions 18 months. There will be delegated acts, implementing acts to specify certain provisions. But a lot of what is in MiCA can already be complied with now. And I really recommend to everyone, whether you're in the EU or outside, there's a lot of good practice in there. For example, if you issue tokens, make fair disclosures. Don't make false promises. Don't pretend that people are going to become rich if they buy your token. If you are a crypto asset service provider, do map out what your conflicts of interests are. Manage your conflicts of interest. Separate the assets of your customers from your own assets. These kind of things are requirements which are enshrined in MiCA, but there's no need whatsoever to wait 18 months from now to comply with it. Go at it already now, not because it's a regulatory requirement, but it's good sense. It's good business sense to do this. And the entire crypto community, the entire crypto ecosystem will benefit from increased practices and increased confidence consumers can have in well-regulated and well-governed crypto markets. So I would say go out there, and if you find what is in MiCA unclear, or what was intended, or what should I comply with, send us a message, and we're quite happy to say, well, this is what we had in mind, and this is why we think it's a good practice.
Peter, thank you so much for that answer. We could do an entire hour and on MiCA implementation, and spoiler alert, we are going to do a full hour on MiCA implementation because it's really important, right? You have the legislation, but you have to actually enact it, and that's going to come down to the member states and cryptocurrency businesses sort of aligning there for sure. Peter, really can't thank you enough. This has been a long time coming. Have been wanting to have you on for a while, and really honored that you joined us. And folks want to hear about this, and they want to hear about it from the people who know. So really, thank you for joining TRM Talks. Really appreciate it. And for everyone else with us, thank you for joining us. Subscribe to the weekly roundup. Please fill out this survey and give us feedback. Give us feedback on content. Did you like our new sort of live with Ari and Isabella morning show vibe that we were working on, dual moderating? Join us for next month for TRM Talks. And as always, thank you all so much for working with us to build a safer financial system. Have a great day, everybody.